AI is no longer a software boom, but one of the largest infrastructure buildouts in modern history. Rapid data center expansion sounds great, but becomes worrying when debt is outpacing revenue 2 to 1. Now, this period in time lines up similarly with other expansive economic periods in human history. The founding years of the railroad system in the 1800s and the inception of the internet in the 80s and 90s both bankrupted the American system to a degree before ushering in a new standard of living. So let's go over some numbers and review all you need to know about artificial scaling. When people hear AI, they immediately think of NVIDIA GPUs or AI models like ChatGPT, but it's much more complex than that. AI requires physical infrastructure before any future demand for software models materializes. This comes in the form of first obtaining the lease for the land, then creating power generation of the electricity, which then needs to be transmission to the servers. Once the data centers are fully built, liquid cooling has to be implemented, which is a topic on its own, and then network for connectivity with all the wires and servers that need to be put in place, which finally leads to cloud compute power, which is the service that AI centers are buying for their software protocols and their models. Now let's get into numbers. The big four hyperscalers that are spending the most money on CapEx on a quarterly basis are Microsoft, Amazon, Google, and Meta. These four hyperscalers spent up to $413 billion in 2025. And if you want to add a fifth company in Oracle, the number total ends up being $500 billion. Now, the global numbers are even higher. Total worldwide spending on artificial intelligence is up to $1 trillion, with another $600 billion just waiting in investments for future data center creation. That's almost $2 trillion in 2025 alone, and that's not even including the amount of debt that was issued during that time that is on paper, which is $182 billion globally, up from $92 billion last year. So it doubled. Now let's talk shop. Chatter around Twitter is that the CapEx spending is completely out of control, that the debt is never going to ever be paid off by the amount of revenue that CapEx and AI spending is currently making. However, if you look at the debt to EBITDA ratio on a quarterly basis for these four hyperscalers, including Oracle, none of them exceed 1.3 debt to EBITDA ratio, meaning it would take them a year and 3 months or sooner to pay off all outstanding debt with their current revenue numbers. Now, these numbers look great when they're reported on CNBC, but there's something a little bit fishy because they're just way too clean. We know from our research into special purpose vehicles that the majority of this debt is being written off somewhere in Panama or the Cayman Islands. Actual debt obligations are being held off balance sheets and off quarterly earnings so they could hide the fact that they are over $650 billion more in debt than is actually reported. So when you compare these total debt numbers to the amount of revenue that's actually being brought in, the numbers look a lot uglier. Hyperscalers like Google are burning through their cash flow at record pace, and their revenues are not even coming close to matching their debt issuance by comparison. Juicing up quarterly EBITDA revenues every single earnings season is a great way to justify the S&P moving higher, but incredibly worrisome when you factor in the amount of debt that is not being serviced under the hood. The AI bubble is real, and you should be worried.